Imagine, like a $5 million titanium arm in a Tokyo factory.
Okay.
And it doesn't just weld steel, it actually sees a microscopic defect on the assembly line, analyzes the problem in milliseconds, and then adjusts its own grip in real time.
Right, without anyone prompting it.
Exactly.
Okay.
All without a human being ever touching a button. I
Mm.
mean, that is where artificial intelligence is moving right now.
Yeah, we are so used to the idea of AI being confined to a screen. You type a prompt, a chatbot writes an email, or maybe it generates a funny image for you.
Right, the digital stuff.
Exactly. But the real economic earthquake happens when that digital intelligence gets physical hands, wheels, and an actual job in the real world.
Which brings us to today. Welcome to this special Time in the Market Deep Dive. Today, we are putting a magnifying glass on the Global X Robotics and Artificial Intelligence ETF.
Better known by its ticker symbol, BOTZ.
Right, BOTZ. Now, before we get into the gears and wires of this fund, just a quick reminder that this deep dive is strictly for entertainment and educational purposes. You should always seek professional financial advice before making any investment decisions.
For sure. I mean, investing in cutting-edge tech carries its own unique set of risks, especially when you're dealing with industries that are, evolving this rapidly.
Yeah, absolutely. So today's mission is a comprehensive analysis of BOTZ.
Mhm.
We're going to unpack what it actually means to invest in this physical AI revolution, break down the ETF's current market performance, its valuation multiples, and compare it against its biggest competitors.
And then ultimately arrive at a data-driven buy, hold, or sell verdict.
Right. Based purely on the current analyst and technical sentiment we've got.
It is a fascinating space because we are talking about embodied AI. This is really where the code literally meets the concrete.
Okay, let's unpack this. Embodied AI. If standard generative AI is like a brain floating in a digital jar,
Great visual.
thanks, then BOTZ is essentially investing in the nervous system, right? The eyes, the robotic hands that let that brain actually interact with the physical world.
Exactly.
But if you're a listener thinking, I want a piece of this revolution, you really need to understand what you're actually buying under the hood here.
Yeah, you're not buying a broad, safe, evenly spread bet on thousands of tech companies. This fund is, well, it's highly concentrated.
Very concentrated.
Over half of the entire fund's value, about 58%, is tied up in just a handful of giant companies.
Let's talk about who those giants actually are. I mean, obviously, you've got NVIDIA
Naturally.
providing the computing brains, and they make up over 8% of the fund. But then you have these massive industrial players that most people outside of manufacturing have probably never heard of.
Right, companies like Keyence.
Yeah, which hovers around 9%. ABB Ltd is at nearly 9%. Fanuc is right up there, around 8.9%. And then Intuitive Surgical is sitting between 6 and 7%.
And to understand why these companies matter, you really have to look at what they build. Fanuc, for instance, makes those massive, iconic, yellow robotic arms you see in automotive plants.
Oh, the ones that are always in the car commercial montages.
Exactly those.
Yeah.
They are literally the muscle of global manufacturing. And then Intuitive Surgical, they're the pioneer behind the Da Vinci surgical systems.
Right, the medical robot.
Yeah, these are machines that translate a surgeon's hand movements into incredibly precise microincisions, and they are increasingly using AI to analyze data from millions of past surgeries to, improve patient outcomes.
Wow. And Keyence is essentially building the eyes for these machines, right?
Yeah, machine vision sensors.
Right, so that allows a robotic arm to actually perceive its environment. Plus, geographically, this fund is very specific. You've got a heavy reliance on the United States, roughly 32 to 36%, and Japan making up about 30% of the fund.
And that heavy weighting toward Japan is definitely no accident.
Why is that?
Well, Japan's rapidly aging population and declining birth rate forced them to innovate in robotics decades before the rest of the world felt the pinch.
Oh, I see.
Yeah, they physically did not have the young workforce to run their factories, so they poured capital into automation. That gave companies like Fanuc and Keyence a 30-year head start on research and development.
I have to push back on this concentration, though.
Yeah.
I mean, if someone is buying an ETF, they're usually looking for diversification.
Sure.
Isn't it incredibly risky that a fund promising exposure to a massive, global, multi-industry revolution is placing over half its chips on just 5 or 6 companies? Like, if one of them stumbles, the whole fund takes a massive hit.
What's fascinating here is the underlying economics of how the advanced robotics industry actually works. Generative AI and advanced manufacturing have a really distinct winner-takes-all dynamic.
Okay.
Because BOTZ is a market value-weighted ETF, it naturally leans heavily on the titans, basically because they are the only ones who can afford to compete.
Because building physical AI requires so much capital.
An almost incomprehensible amount of capital. You need deep pockets for the software development, obviously.
Right.
But you also need existing dominant supply chains to build the hardware. These companies have spent decades building impenetrable economic moats.
Yeah, that makes sense.
A brilliant startup in a garage can write a great software app overnight, but a startup cannot easily build a global manufacturing footprint or navigate international medical device regulations and then deploy a fleet of precision surgical robots.
Yeah, the barrier to entry is just too high.
Exactly. Information technology, the software side, and operational technology, the physical hardware side, are finally merging. And that integration heavily, heavily favors the established giants.
So if these massive companies have such impenetrable economic moats, you would think their stock prices would be completely bulletproof.
Yeah.
But when we look at the actual performance, it's a bit of a roller coaster.
It really is.
Currently, the price of BOTZ is hovering right around $40.60. And the performance metrics are wild when you contrast the short term with the long term.
It's a tale in two timelines for sure. Over the last year, BOTZ boasts a stellar return of roughly 32% to 35.5%.
Just explosive growth, obviously fueled by this massive AI boom we've been living through since late 2022.
Right.
But then you look at the 5-year annualized return, and it's much more modest. It's hovering way down around 2% to 2.6%.
Which tells you that before the recent generative AI breakthroughs, this sector was facing some very real headwinds. The hardware was there, but the brain, wasn't quite smart enough yet to justify mass deployment in highly unpredictable environments.
Here's where it gets really interesting because we have to talk about the valuation multiples.
Oh, yeah.
The current PE, the price-to-earnings ratio, is sky high at 42.03. Now, the forward PE offers a tiny bit of relief, dropping down to 32.74.
Still very high.
Yeah, and the price-to-book value is sitting between 4.19 and 4.60. Just to clarify for the listener, price-to-book means if we liquidated all these companies today,
Sold off every factory, every patent.
right, every robotic arm, you as an investor are paying more than 4 times what those physical assets are actually worth on paper.
A PE of 42 is massive for companies that are largely building physical industrial machines. Traditionally, you only see those kinds of multiples in pure software companies that have near zero marginal costs to scale.
Exactly. So I have to ask you, are investors just paying a massive premium because someone slapped the AI buzzword on these companies? Or do the underlying economics actually justify this kind of price tag? I mean, frankly, doesn't hardware get outdated quickly?
That's a great
A
point.
software update is cheap. Replacing a $5 million robotic arm is not.
The life cycle of the hardware is a very real challenge, and we should definitely circle back to that idea. But to understand why the market is tolerating a PE of 42 right now, you really have to look at the macroeconomic runway for growth.
Okay, let's look at it.
The global robotics market is valued at an estimated $108 billion as we approach 2025. But forecasts suggest it could nearly quadruple to $416 billion by 2035.
Quadruple in 10 years.
Yeah.
That is a staggering projection.
And that growth isn't just based on hype, it's being driven by powerful structural tailwinds. First, the cost of AI compute is steadily declining.
Which makes these robotic systems more economically viable to deploy at scale.
Exactly. And second, we are seeing massive global reshoring efforts. Take the U.S. Cheap PS Act, for example.
Let's break that down quickly for the listener. The Cheap PS Act is basically a multi-billion-dollar government push to bring microchip manufacturing back to American soil,
Right.
largely to protect against global supply chain shocks.
Correct. But manufacturing microchips requires incredibly sterile, hyper-precise facilities. You can't have humans shedding skin cells or making millimeter errors in a semiconductor fab.
Definitely not.
Furthermore, American labor is expensive. So if you are bringing manufacturing back to the U.S., you have to heavily automate it. Government policy is actively accelerating the deployment of the tech these companies sell.
What about internationally, though?
Over in Europe, the phased implementation of the EU AI Act is actually providing regulatory clarity.
Oh, that makes sense.
Yeah, for years, major corporations were hesitant to invest hundreds of millions into autonomous systems because they didn't know if regulators would suddenly ban them.
Or severely restrict what they could do.
Right. While the new act introduces compliance costs, it gives businesses the certainty they need to finally pull the trigger on major automation investments. They know the rules of the road now.
Oh, okay.
So the market is pricing in this massive projected growth. Investors are paying for the earnings of tomorrow, not the earnings of today.
Given that massive $416 billion projection, if you're a listener, you might be wondering, is BOTZ the only way to play this trend? Is it the safest way?
It's definitely not the only way.
Right, because there are other players on the field. To keep with our physical, embodied AI theme, think of investing in these ETFs like outfitting a massive new automated factory.
I like this analogy.
So we're just established that BOTZ is a highly concentrated fund. It's like putting all your capital into the 5 biggest, most expensive 5-ton robotic arms on the assembly line. High reward if those specific machines dominate production, but incredibly high risk if they break down.
It's a very aggressive, top-heavy strategy.
Right. But how does that compare to something like Robo, the Robo Global Robotics and Automation Index ETF?
So Robo employs an equal weight strategy. They ensure that no single holding exceeds 2.5% of the portfolio.
Oh, interesting.
So in your factory analogy, Robo isn't buying the massive arms. It's buying a single crucial bolt in every single machine across the entire factory floor.
Spreading it out.
Yeah, it spreads the risk across small and mid-cap companies. You get far less volatility and much lower concentration risk than BOTZ. It's built for a more conservative investor who believes in the broad theme of robotics but doesn't want to try and pick the specific mega-cap winners.
Then there's IRBO, the iShares Multi-Sector ETF.
IRBO is globally diversified across 48 companies, notably including emerging markets, and it has a lower expense ratio. So that's like investing in smaller, diverse factories all over the world, looking for value plays rather than just established titans.
And finally, we have the heavyweight in the room, AIQ, which has $7 billion in assets under management compared to BOTZ's, $3.7 billion.
Right, and AIQ takes a totally different approach. It isn't just focused on robotics, it focuses on the broader AI ecosystem.
Like what?
Software, cloud computing, and semiconductor fabricators like TSMC and Samsung. If BOTZ is buying the robotic arms, AIQ is investing in the electricity and the software network that powers the entire building.
So why does choosing between these different strategies matter so much for the person listening to this right now?
If we connect this to the bigger picture, it's about the dispersion of returns. Since ChatGPT launched back in late 2022 and kicked off this current era, there has been a massive 20 percentage point performance gap between the best and worst performing AI ETFs.
Wait, 20%?
Yes.
Just based on how the ETF is structured internally?
Exactly. Recently, the market has heavily rewarded the market cap weighted funds like BOTZ because the biggest companies, specifically NVIDIA, have been driving almost all the market gains.
Right, NVIDIA's been on a tear.
The equal-weighted funds like Robo have lagged a bit in this specific cycle because they actively cap their exposure to those mega-cap winners at 2.5%.
That makes sense.
But, and this is crucial, thematic ETFs like these are inherently volatile. The standard financial advice is that thematic funds should generally only make up about 5% to 10% of a well-diversified portfolio.
Keep it contained?
Yeah, they are the turbochargers in your engine, not the entire vehicle.
That is a great reality check. You don't want your entire retirement riding on whether a humanoid robot can do a backflip or build a car flawlessly.
No, you definitely do not.
So having looked at the underlying thesis, the macroeconomic environment, the valuation, and the competition, let's synthesize all this data and deliver the current market sentiment and our final verdict.
Let's start with the short-term outlook. Analysts are solidly optimistic here. They have an average 30-day price target for BOTZ of $44.53.
Okay.
That represents a 9.4% upside from the current $40.60 price.
And the long-term forecasts, based on historical trends and those massive earnings projections we discussed earlier, suggest BOTZ could average $52.39 by 2035 and potentially hit $87 by 2050.
It's a steep curve.
Yeah, but the technical analysis is what's really jumping off the page right now.
Right.
The technicals are heavily bullish. Out of 18 different technical indicators, 10 are signaling buy.
Right.
6 indicators are neutral, and only one single indicator is signaling sell.
And those buy signals include key moving averages and the MACD.
The moving average convergence giver.
Exactly. For anyone unfamiliar, think of the MACD like a speedometer for a stock's price. It tells us not just if the price is moving up, but if that upward momentum is actually accelerating.
And right now.
Right now, the speedometer is showing strong acceleration.
In fact, Market Edge rates the ETF as a strong buy, with a very high confidence score of 9.6.
Mm.
So, based purely on the technical indicators and the aggregate analyst targets provided in our data, the final verdict for BOTZ is a strong buy.
The momentum is clearly there on paper.
So what does this all mean for you, the listener? I have to offer a final pushback on this strong buy verdict.
Go for it.
Yes, the moving averages look great, and the mass DD is accelerating. But look at the ETS beta. It sits between 1.45 and 1.68.
That's high.
Very high. For those who might not know, beta measures volatility compared to the broader market. A beta of 1 means a stock moves exactly in line with the S&P 500.
Right.
A beta of 1.68 means this fund swings much harder in both directions.
Mm-hmm.
If the market goes up 10%, BOTZ might go up almost 17%. But if market drops 10%, BOTZ is plunging 17%.
A huge swing.
Yeah. If someone buys in right now based on that strong buy signal, are they just strapping themselves into a financial roller coaster?
That is a completely valid concern, and it's exactly why that 5 to 10% portfolio allocation rule exists. High beta absolutely means high risk. You have to remember the concentration risk we discussed earlier.
Right, the 58% in a few companies.
Plus, because 30% of this fund is tied to Japanese companies, you are incredibly vulnerable to Japanese currency fluctuations.
Oh, I hadn't even thought of that.
Yeah, if the yen swings wildly against the US dollar, the value of those holdings in BOTZ is impacted, regardless of how many robots Finucane actually sells. You are taking on international currency risk on top of bleeding-edge technology risk.
To manage this strong buy safely, how does someone actually enter this position without getting burned by a sudden dip?
The most reliable strategy for a highly volatile asset like this is dollar cost averaging. Don't take a massive lump sum and dump your entire allocation in today at $40.60.
You just buy a little at a time.
Exactly. Buy a set dollar amount every month. If the high beta causes the price to suddenly drop to $35, your monthly investment automatically buys more shares at a discount.
Ah, I see.
It smooths out that roller coaster ride over time and takes the emotion out of trying to perfectly time a hype-driven sector.
It allows you to participate in the long-term trend of the physical AI revolution without losing sleep over the short-term swings.
That makes perfect sense. Well, we have covered a massive amount of ground today, from brains in digital jars to billion-dollar robotic assembly lines. Thank you to everyone for joining us on this deep dive into BOTZ.
It's been a great discussion. And to close out, I want to circle back to that excellent point you brought up earlier about hardware versus software life cycles. I want to leave you, the listener, with a final thought to mull over.
Let's hear it.
We are all very used to our smartphones and our software becoming obsolete every 2 or 3 years. You know, the software updates, the phone slows down, you trade it in, you get the new one.
Right, it's pretty normal now.
It's a relatively cheap cycle.
Okay.
But as artificial intelligence fully merges with heavy industry, what happens when a $5 million factory robot or a multi-million-dollar surgical machine faces that exact same rapid cycle of technological obsolescence?
Wow. When physical, concrete infrastructure suddenly needs a software-style upgrade cycle every 3 years just to stay competitive, who pays that bill?
Code-meaning concrete is going to be incredibly expensive. Something to think about the next time you see a robot doing a job a human used to do. Until next time.